All right, let's get right into it. For the longest time, carbon credits were kind of seen as this niche, almost charitable thing for companies to do. But something has fundamentally shifted. We're going to explore how these credits are being transformed into a core, structural, and, yeah, potentially trillion-dollar asset class, the financial engine for a global green transition.
To really get why this is happening, you have to start with this number, $106 trillion. That is just a staggering amount of investment that's needed between now and 2040 to modernize the world's infrastructure. We're talking energy grids, transport, digital networks for a low-carbon future. And that, of course, leads to the million-dollar, or I guess the trillion-dollar question, how on earth do you finance something that massive? Where does that kind of capital actually come from?
Well, the answer that's emerging is both pretty radical and honestly a little controversial. We're going to finance it by turning the very atmosphere into a tradable asset. Carbon credits are evolving from just a simple offsetting tool into the actual currency that's going to underwrite this whole infrastructure moment.
But look, for carbon credits to become a real asset, the market had to clean up its act. It went through this painful but absolutely necessary correction, a great reset, if you will, that shifted the entire focus from just quantity to real quality.
And this shift created a really clear split. You see, the old system was kind of like the Wild West. It was voluntary and totally dominated by what are called avoidance credits. Think of it like paying someone not to do something, like not cutting down a forest. The problem? It was really hard to prove. The new market is a completely different beast. It's built on verifiable carbon removal, actively sucking carbon out of the atmosphere, either with nature or with tech, all backed by high-integrity data.
And the financial result of this whole reset is just stark. A huge price gap has opened up. Those old legacy avoidance credits, they're basically worthless now, trading for less than $4. Meanwhile, high-quality projects that restore nature are commanding over $20. And engineered tech-based removals, they start at $170 and go way up from there. The market is sending a crystal clear signal about what it values now.
So the big takeaway here is that not all carbon credits are created equal, not even close. At the bottom, you've got those old legacy credits that have just collapsed in value. In the middle, you have high-quality nature-based solutions like reforestation projects. But way up at the top, engineered removals like direct air capture or DAC. These are technologies that literally pull CO2 out of thin air. And because they offer permanence and scalability, the market is willing to pay a massive premium, sometimes over $1,000 a ton.
When you start seeing prices like that, well, you're going to attract some serious attention. The giants of Wall Street have absolutely taken notice and are now building the whole institutional framework to turn carbon into a professionalized, grown-up asset class.
And we're talking about mind-boggling sums of money here. Brookfield Asset Management recently closed the largest decarbonization fund in history at over $23 billion. TPG is raising billions to focus specifically on negative emissions. This isn't just some feel-good impact investing anymore. This is big finance treating carbon removal as a long-term profitable business. And hey, it's not just the private equity folks. The world's biggest commodity traders are jumping in with both feet. Trafigura went from zero to trading over 100 million tons of carbon a year in just 3 years. These are the companies that dominate oil and gas, and now they're bringing that same trading sophistication and liquidity to the carbon market.
Now, the big banks, their story is a little more complicated. Publicly, because of a lot of political pressure, major players like JP Morgan have actually backed away from these voluntary climate alliances. But behind the scenes, it's a totally different story. They're building out super sophisticated tools, like JP Morgan's Carbon Compass, to analyze and manage climate-related risks across their massive loan books. Okay, so you've got the money, you've got the big players. But for a global asset to really work, you need trust, you need transparency. And that's where this whole new layer of rules and technology comes into play.
It all starts with something called Article 6 of the Paris Agreement. The easiest way to think about it is as the official international rulebook. This is what moves carbon trading from that messy, voluntary system to a state-authorized one, where countries can actually trade credits, they're called ITMOs, to meet their official climate targets.
And the process it creates is actually pretty straightforward, but it's absolutely crucial. So let's say one country generates a credit. Another country can buy that credit, that ITMO we just mentioned, to help meet its own climate goals. But here's the key. The selling country then has to adjust its own carbon tally. This prevents the same emission reduction from being counted twice, and that's the bedrock of trust for the whole system.
Then, on top of that rulebook, you start to layer in the tech. And this is where it gets really interesting. Blockchain platforms like Toucan are basically turning carbon credits into digital tokens. Now, why does that matter? Because once a credit is on a public ledger, its entire history is transparent. It can be audited by anyone at any time. This makes trading instant and helps solve those big double-counting trust issues that plague the old market.
And finally, you have the ultimate layer of proof. AI and satellite imagery are becoming non-negotiable. This means you no longer have to just take someone's word that a project is working. Instead, you get real-time, data-driven evidence from space that a forest is actually growing or that carbon is truly being stored. Okay, so with all this money and all this cool tech, it's really easy to get swept up in the hype, right? But we've got to pump the brakes for a second and look at the other side of the coin. There are some significant risks and some really powerful critiques of this entire model. And this quote right here from researchers at Oxford, it really cuts to the heart of the whole critique. After looking at 25 years of evidence, they're asking a vital question. Is offsetting just an easy way out? They concluded it can be a dangerous distraction, letting companies just buy credits instead of doing the much harder work of actually cutting their own emissions at the source.
And listen, this isn't just some academic theory. We're seeing a huge delivery risk in the real world. The UK has already admitted its 2030 carbon capture target is just not achievable. In the US, they've struggled to actually spend the billions they've allocated for this stuff. And the market itself for these high-tech removals is super concentrated. Microsoft alone has bought up the vast majority of all the credits sold so far.
So all of this really brings us to the core dilemma, doesn't it? Are carbon credits a vital part of the climate solution, a tool we absolutely need to finance the transition, or are they becoming a massive financial distraction that just delays real action? You know, at the end of the day, there is no easy answer. What we know for sure is that the atmosphere has been financialized. It is now a traded asset. So the real trillion-dollar question is this: will this new market actually help save the planet, or have we just created a complex new financial game for Wall Street to play? The next few years are going to tell us everything.